Hello and welcome to today's premium account market update for the ASX Top 50 April 2019. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have 22 years of experience in the financial services industry and a licensed securities and derivatives advisor. The topics for today: we look at the macro update driving equities, we roll through the ASX Top 50 with a focus on FY19 earnings, we look at dividends, forward earnings growth, technical trends, portfolio allocations, and conclude with a short-term market outlook. The Investor Signals Premium Broking Account service is a broking account based on the model portfolio of ASX Top 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates, generating above average cash flow while still looking for capital growth. It's in a strict investment mandate, therefore suitable for self-managed super funds. Importantly, the assets remain in your name, and we use Macquarie Cash Management Account to link your cash to the broking service. If you're interested in the Investor Signals Premium account, please contact me on 1300 614 002 or send me an email, leon@investorsignals.com. Moving straight into a graph of the XJO. Now, following the December sell-off, the markets rebounded strongly. In the US, we're pushing up against the prior highs in September, October. Our markets a few percentage points shy of that. From a valuation standpoint, we're still of the view that a good outcome from the market from these levels is that it moves sideways, and it lends itself to an environment where a number of stocks you want to be looking at selling covered calls to enhance the income, and I'll focus on those names that we have in our model portfolio at present as we roll through the top 50 stocks. So if we click on watch list, go into the 50 names, and we'll go through them in alphabetical order. So starting with AGL. As interest rates have come down, we've seen yield-sensitive names rally. AGL, I think, is going to deliver moderate earnings growth. It's on a 5.5% dividend yield. Owning it here and selling covered calls, I think, helps to generate so that 10% cash flow from a stock that's mostly likely to move sideways. Aristocrat Leisure's been a favourite among fund managers. It was growing at almost 20% per annum. We've seen the PE contract from sort of mid-20s back down to about 17, 18 times forward earnings. The stock's only on a less than a 3% dividend yield at the moment, and I think the earnings growth rate is slowing a little, but it probably still remains a fairly bright spot relative to other areas of the market. We're just mindful at the moment that it's under sell conditions and there is a bit of resistance around that 26.50 level, but there is opportunity whilst the market remains strong for a sort of shorter term exposure to Aristocrat. Amcor, so this is a stock that we're very bullish on. The Bemis acquisition is being finalised at the moment. We've seen the stock pop on Friday as we saw the South American regulators approve the acquisition of the South American assets of Bemis Group without having to divest any of those, which just helps to make the transaction a little bit cleaner. I think Amcor still faces some potential issues in North America where they may have to spin off certain segments of that Bemis business to over the next sort of 6 to 12 months to appease the regulators in North America. But for the most part, Amcor is now full value, so we expect underlying earnings growth in low single digits. There's about $180 million of cost synergies to strip out over the next 2 to 3 years as they integrate with Bemis. But for the moment, the stock's full value, and you want to look at selling call options over that. AMP, we're not doing there at present. ANZ, so this is one of the few banking stocks that are in our model portfolio. We see support here at around $26. It's under algorithm buy conditions. We saw JP Morgan's result came in about 5% above on the revenue line, 5% above on the profit line, and I think that should bode well for the banks in the early part of this week, and that will then give an opportunity, I think, to sell call options. I don't see that we're in an environment where the banks can really steadily grow revenue, so the dividend yield's attractive, and any move slightly higher during the course of the week's an opportunity to sell call options over ANZ. ANZ goes ex-dividend next week, so you're able to strip out the dividend. Oh, sorry, not next week, next month. So you're able to strip out the dividend as well as collect that extra call option income and turn sort of that 6% yield into 10 to 12% cash flow. So if you'd like to know more about that call option strategy, again, give me a call in the office and happy to have a chat. But ANZ at these levels looks interesting. APA Group, so this is infrastructure name, gas pipeline business, ran in a resistance there around 10.20. We'll take a look at that on the next algo buy signal. Not really doing anything there at the moment. ASX remains one of the preferred allocations within the financial services space. The stock continues to make higher highs and higher lows. It is getting a little expensive. It's trading up around 28 times earnings on just over a 3% dividend yield. Trading volumes were strong. I think derivatives were up about 12% on the same time last year, and equity volume was up about 9%. So from a pure, obviously ASX makes their money from transactions, the number of shares that are bought and sold through the ASX. So that volume increase is helping to underpin slight earnings upgrades, whereas the market was thinking maybe only 4% earnings growth. It looks like they're going to deliver about 6% earnings growth. But with the PE at 28 times earnings, the stock is expensive, but as we're all aware, a lot of money's chasing yield at the moment as interest rates have moved so low. Horizon, there'll be another opportunity to buy into Horizon. We owned it at lower levels. We've taken profit. If a pullback to around 425, I would see that as a good opportunity to buy Horizon. I think it mainly trades sideways over the next 6 months, but it does pay a reasonable dividend yield there at about 5.5%. So when you add a covered call to it, you are getting a reasonable return. BHP, to me it would appear that sort of this iron ore trade is getting pretty close to an exhaustion point. So I think BHP is still the standout preference within the resource space, certainly over Rio or South 32. Woodside Petroleum is the one that I think from a timing standpoint you want to be adding that to your portfolios. But BHP, if you do own it up here, look at selling covered calls over it. Bramble, so this stock's holding up well on anticipation of a special dividend coming back to shareholders through the sale of their plastic pallet pooling business. But again, it is expensive, up at 21 times earnings on a 2.5% dividend yield. So these valuations in the market at the moment are really at the top end of the range, and there's some uncertainty around earnings growth. And I think in order for the market to really move higher, we need to see some level of synchronized global growth re-emerge and some upgrades coming through, or at least very bullish outlook from the earnings guidance from these companies, because the rebound that the markets had from that December sell-off really has got ahead of itself from the perspective of what we know about the current earnings trends. So the market's starting to price in a reasonable rebound in the second half of the year, and obviously if that doesn't occur, that's where the risks then begin to build. Brambles is fair value back more around 10.50, so whether throughout the course of this year we see it pull back to that level, we'll wait and see. Commonwealth Bank under algorithm sell conditions. If we look here, the sell-off from $90 through to 71's been. We've had a number of sell signals there, and we'll just maybe in the back half of this year we see the banks turn into buy signals, but we're really not there at the moment. So the basis is that it's either pushing slightly lower or moving sideways in line with our view on the index. Cochlear, we can see here that it's rolled over, made a lower low. We're under algorithm sell conditions, and the momentum seems to be faltering there in Cochlear. We don't hold that in portfolios. Coles Group, we traded this from around this 11.25. We've taken profit where it is at the moment. The concern for Coles is capital spending. We've seen the profit fall substantially in the February earnings result, but as interest rates have come down, the market's chased sort of trusted names and defensive yield, and it's starting to look a little bit expensive in a backdrop where we know that earnings were falling as disclosed in the February results. So I'd be, until there's evidence that those earnings have troughed, then you'd have to be probably more inclined to look to sell the rallies in coals. So hence, we've been happy to buy it on the dip there, as we thought the market got a bit negative following the earnings result. But back at this level, it looks a bit expensive again to me. Computershare, I think there's structural issues that Computershare is going to face over the next few years, and I think analysts have got too high a price target. I think Computershare trades lower. CSL, so we like this name. Where it was growing earnings sort of 15%, maybe that comes back to 8 to 10%. So it is expensive, trading somewhere up at around 30 times earnings on a less than a 2% yield. So again, owning it and selling covered calls is the way to drive that extra cash flow out of CSL. Keltec, so we've got their share buyback, off-market buyback occurring in Keltec's. Fairly flat earnings growth over the next 12 months. Stock trades on about a 3.5% dividend yield, fair value, but you can see it's under sell conditions, and the last signal there at around $28, and the stock's moving lower. So to the extent that anyone owns Keltec, I think selling call options up around 28.50 and driving that extra cash flow until there's evidence of an earnings uptick. The real estate investment trusts have done exceptionally well over the last 6 months as interest rates in the US have come down. You've seen money pile into these REITs. You'd have to be of the view that that has probably exhausted. You're starting to see yields in the US creep back up again after sort of the panic low levels that were created following the December sell-off in the market. So our view on the real estate investment trusts is they're back up against resistance based on valuation and yield compression, and now's the time where you either want to take profit in them or sell covered calls. And it's a reasonable outcome just to decide to sell covered calls, given that we think interest rates stay relatively low, so the downside risks to the REITs I think are relatively contained. So therefore, stripping out the dividends, selling call options, you're getting that 10% cash flow from something that would have a fairly low downside risk in this interest rate environment. Fortescue, we'll take a look at Fortescue again mid-year. We think the iron ore trade's got ahead of itself, so maybe around July, August this year we see a more substantial pullback in some of these commodity names, and we'll be aggressive buyers on the dip when that occurs. So we'll wait for the next algorithm buy signal in some of these larger resource names at the moment. Goodman Group, so we had the algo buy signal there at around $10, pushing $13. I think Goodman Group continues to be in probably the more attractive area of the real estate investment trust area, where they're obviously building fulfillment centres and large-scale distribution centres, mainly utilised by online businesses. And you're starting to see GPT push into that space as well. But the algorithm model did an exceptional job there of picking up the entry level at $10, and it's been one of the better performing stocks within the model, as is GPT, which has really been our preferred exposure, given that we can do call option strategies over GPT. But it's switched from sell conditions into buy conditions there at around $4.80 to $5, now trading $6, close to full value. They'll probably only grow earnings about 4%. The stock's now on 5% dividend yield, so selling, for example, the 625 call options, you're turning that into a 10% annualized cash flow. Insurance Australia Group, a little bit cautious on this name. So we've been selling the 775 call options as a way of stripping out extra income against Insurance Australia. So I think the upside's a little bit capped here at the moment. So definitely one where you add the covered call strategy. James Hardie, so we've seen this roll over, make a lower low. We've now had a bounce back. It's under a lower high formation, so we're not really aggressive, or we're not doing too much in portfolios with including James Hardie. The one that is on the radar, as I've been communicating on the blog, is Boral. That looks oversold. Lendlease, I think this is one that you can keep on your watch list. The cost overrun in the engineering business, there was $700 million cost overrun against a $2 billion project. That engineering division, Lendlease, has engaged the investment banks over the last month or two, and I understand that an information memorandum's gone out to interested parties, so we'd expect to see some movement on that over the coming months, and I think any news on the sale of that engineering division will act as a catalyst to see Lendlease probably trade back up to around $15. I think there's enough caution in the market in general around property development, especially large scale unit complexes, which is a reasonable part of Lendlease's business, albeit that Lendlease is a global player in that space, and sales in Singapore and Asia and the UK, I understand, have been very strong. So while maybe there's a bit more negative sentiment around that space in Australia, I would not expect to see a major slowdown in their international sales. So looking for Lendlease to re-rate back up towards $15. Mirvac Group, not doing there at the moment. Medibank Private, so again in a low interest rate environment, Medibank's not really growing revenue, but a fairly stable profit. Bottom line, trading on a 4% dividend yield, owning it here and selling covered calls, but again you can see it's under sell conditions. So to put into perspective the number of stocks that are under sell conditions versus buy, in the model portfolio, we only have 12 stocks out of the 50 that are actually under buy conditions at the moment. So for the most part, what it's saying is this bounce back in the market's creating a lower high for a large number of stocks, and that is often associated with some level of caution being required in the market. One that is under strong buy conditions is Macquarie Group, so we've seen that generate buy signals and added into the model portfolio at around this 100 to 110 level, now pushing 130. Analysts are upgrading the earnings outlook for Macquarie, upgrading price targets to around 140, and the stock appears now to be breaking out and creating a new high, so it still retains a bullish pattern there in Macquarie, and it's one of the better performing stocks in the model portfolio. NAB under algorithm sell conditions, we can see here that it's made a series of lower highs starting from $30 back in March last year and continuing to make lower lows. After the substantial correction that the banks have had, the Royal Commission, we're probably in an environment that we get a consolidation move at the moment, but not many buy signals present in the major banks at the moment. Newcrest, not doing there at the moment. We have other, so Evolution, North Star, our preferred gold exposures at the moment. Origin Energy, so whilst this is under sell conditions, I just highlight that the company's done a great job of paying down debt, and as energy prices have rebounded over the last 6 months or so, we've seen Origin's dividend stream come through from their Asia Pacific LNG project up at Curtis Island, is really helping to allow the company to restore their dividends. So based on the full year payment or dividends returning from both the upcoming August period and again in February next year, we have Origin returning back to about a 4.5% dividend yield, which makes it attractive, and I think in that environment we could see it push back up to around $8, $8.50. Orica, not doing there at present. Oil Search, our preference is Woodside over Oil Search and Santos at the moment. oil search has created sort of this lower low, lower high structure there, whereas Woodside looks more bullish. Qantas, we're mindful that that's under resistance at around $6, but likely to track sideways whilst the equity markets are holding up as strong as they are at present. QBE Insurance, so this is a stock that's in the model, so it's one of those 12 companies of the top 50 that I spoke about that's in the model portfolio. So we had the buy conditions here at around 9.50. It was added into the model. QBE should deliver double-digit earnings growth, and we're seeing them spin off or sell off assets around the world, which is helping to rationalise the portfolio, streamline the business a little more, and there may be capital return to shareholders over the coming year or so as asset sales continue. But the stock's broken out, made a higher high, and I think owning it at these levels and selling covered calls over it makes sense. Ramsay Healthcare, so we don't mind this name. Slow growth, 3%, just under a 3% dividend yield, back at around fair value at the moment, and we'll watch that one closely over the course of the next 6 to 12 months for an algorithm buy signal in Ramsay Healthcare. Rio, again, preference is Woodside Petroleum as an actionable opportunity now in the resource space. BHP still prefer that over Rio, and we don't like South 32 at the moment. So Rio we'll take a look at later in the year if we see the pullback in iron ore prices that we expect, and we'll get an opportunity to buy back into that at lower levels. South 32, you can see this is starting to roll over after running into resistance at $4. It was removed from the algorithm or from the model portfolio. We've seen the weakness in the share price over the last few days, and we think that it struggles. On any bounce back, it runs into resistance again and likely heads lower. Scentre Group, this is the Australian Westfield business, trading on about a 5.5% dividend yield. The company's fairly aggressive with their $700 million share buyback at the moment, so owning it here while it's supported by the share buyback and selling covered calls over it, you're generating around 10% cash flow. Probably not a lot in the way of capital gain, so we've been pretty aggressive with the covered calls over Scentre Group. Stockland, a little bit out of favour. You can see it's gone from buy conditions into sell conditions. It's under lower high formation. It's had a reasonable bounce back as interest rates have come back and money's gone into generally, REITs and some of these property stocks, but back up against resistance, and we'll wait for that to show as a buy signal. Sonic Healthcare, so this had been a terrific performer over the last few years. The earnings growth rate starting to slow down to around 3% at the moment. The stock's trading on a fairly high PE and only about a 3.5% dividend yield. So I think the view here is more that the stock's going to trade sideways than really continue with the advances. So to the extent that we own it, sell covered calls over it is, I think, the conclusion there. Santos, again, preference is Woodside over Santos. Oil's had a fair, had a strong recovery this year, and maybe there's some caution needs to be taken as to how much further upside there is in the energy names over the next month or two. Woodside Petroleum has the better dividend yield, better balance sheet, higher quality assets. I think that makes sense to be taking profit out of Santos and Oil Search and reallocating to Woodside. Suncorp, not doing there here at the moment. There's articles in the paper about Bank of Queensland following their poor earnings result that they should consider merging with Suncorp. Whether that's something that really is on Suncorp's radar, we'll have to wait and see. But from a technical standpoint, Suncorp's made a lower low. It's created the lower high here at around sort of this $13.50 to $14. Again, the preference within the banking space as an actionable idea is on the long side of ANZ. there's enough caution around the build-up of these sell signals where we're really not sort of reaching too far to chase opportunities in the market at the moment. Sydney Airports, we don't mind this, owning it and selling covered calls. It's generating a 5% dividend yield. Add in the covered call, you're getting 10% cash flow. I think it moves sideways at around this 725 to 750 level. Transurban, getting too expensive. It's becoming a bit of a crowded trade at the moment. We'll take a look at it later in the year on a pullback, which I'm sure will occur. Telstra, we've seen in the US on Friday night, Trump came out and made a speech around the US's commitment to 5G spectrum and 5G mobile services. I think that just helps to reinforce that Telstra is on the right path. So I suspect that Telstra's hit an inflection point now. Investor confidence should start to build, and we should see it gradually climb higher over the next 1 to 2 years. I don't think there's a catalyst for it to really re-rate quickly up to 450. We do have in sort of 12 to 18 months time the possibility that they spin off Infrastructure Co, which will help to unlock some value, but it should be a gradual recovery higher from here for Telstra. Treasury Wines, see this as being reasonably defensive, but it is on a high valuation, so the market is expecting 15% earnings growth. I'm not 100% sure that they're actually going to deliver that. I think they'll deliver 10% earnings growth quite easily, but on probability, Treasury Wines really moves sideways, just given that it's on a high valuation. So owning it and selling covered calls is the right strategy there. Vicinity, now this is one that's in the model portfolio. It's probably the least preferred property trust that's in the model. I think they got sort of lower growth and asset value shopping centres throughout Australia. If you think about the REITs in order of preference, probably Goodman Group's the fastest growing, GPT's high quality, Centre Group defensive, Vicinity, I think that sort of sits behind those prior mentioned ones. So we don't get so excited about that as an opportunity. Westpac, not doing there. It's up to sell conditions at the moment. Again, preference ANZ within the banking stocks. Wesfarmers, we own Wesfarmers and we've sold covered calls over it. So thinking that it's up against resistance at around $35, moves sideways. If the Linus deal goes ahead, I think that'll be a very good outcome for Wesfarmers. So we'll wait and see how that plays out over the coming months. Woolworths, this is one of the better performing stocks in the model portfolio, so it switched to buy conditions at around $27, now pushing 31, but it is expensive. When we look at it, trades on 22 times earnings on just over a 3% dividend yield, and we know that the earnings growth rate is slowing a little, so they'll probably only deliver about, I think, maybe something around 4 to 5% earnings growth in the latest upcoming results. So it's expensive by any measure, but again, that's just reflected by this late stage of the rebound that we've had since December. People that have missed sort of the profit of that rebound are now rushing for opportunities in the market, and naturally they gravitate towards what are perceived as safe names to invest in, and that's why we're starting to see some of these stretched valuations turn up in the marketplace when you're analysing them. Woodside Petroleum, so it was under buy conditions here at around $30, added into the model portfolio. Given the view that oil prices are pretty close to resistance, I think the outcome for Woodside is that it moves sideways. So selling a covered call up at around sort of $36.50, $37, generating the extra cash flow. I think the downside risks are fairly low. I think we spend the most part of the coming sort of 3 to 6 months with Woodside, trading sideways around that $34 to $36 level, so it lends itself to using the covered call strategy to build returns. So we'll finish today's recording just with highlighting that we've got a large number of stocks under sell conditions. The XJO is for the most part, still sort of above its short-term momentum indicators. We are cautious on a breakdown below those momentum indicators and some hedging needing to be put in place in portfolios. If we go to the model portfolio, click on the top 20, and I'll just show you. So out of the 20 stocks, there's only 8 that are in the model at the moment, whereas historically that was sitting around 14 stocks out of the 20 that were in the model. If we go to the top 50, we're down to 12 stocks that are actually in the model at the moment. If we go to the days held, get the least number of days held. So QBE was added 128 days ago, Woodside, Goodman Group 183 days ago, it's up 32%, Macquarie. So to get the notifications on when stocks are added or removed from the model portfolio, you need to be a subscriber to the members technology. You come in here, turn the envelope on green, and you'll get an email notification when a stock is either added or removed from any of the model portfolios that that the algorithm system runs across. So if you'd like to know more about the technology or trial it, you can get a free trial just by visiting investorsignals.com website. Thank you for listening in, and I look forward to speaking again soon.